Okay, members, welcome back to episode 21. So, in this episode, I'm just going to cover the pairs I trade and the correlation between those pairs. So, if you have a look at my watch list, you'll notice that I've got a select pairs that I trade. So, we've got the US dollar, which is basically just a simplified version of the Dixie. It's more evenly weighted throughout all the currencies, whereas the dollar index is more weighted towards the euro. So you see that the dollar index and the euro are almost identical, but where the US dollar, it will vary a little bit in price action. So for me, sometimes the US dollar is just a little bit more clearer and just gives just a bit more better setups when you're looking, because it's more weighted against all the currencies, like I said, rather than just the dollar. Euro dollar mainly is just going to correlate with US dollar Swiss franc. They've got the highest correlation that I've found. You're going to see more often these to the top four moving together. Pound can do what pound kind of moves on its own. It's a bit more volatile than obviously euro dollar, of course, but pound is more of an independent mover. Aussie dollar and New Zealand dollar, they move practically in sync. It's just that New Zealand tends to just be a little bit more aggressive in the size of the moves. As you can see, the size of the moves are a little bit more aggressive on New Zealand, but overall they typically move in the same direction. US dollar CAD, so let's just get all this off from the last video here. So US dollar CAD correlated with oil, not on a trade to trade basis, more of a long term correlation. So you can see oil started bottoming out around June, September, where CAD started to top out around December, April, May. So you can see April, May, June is when CAD started to top out, and just say June into September, you can see obviously oil started to top out. So they've got a correlation, whereas if US dollar CAD goes down, US oil goes up. UJ is more the safe haven. So UJ is strongly correlated towards gold and silver. So for me, UJ doesn't typically follow the dollar as much as it follows the yen. So if UJ is dropping, that means gold and silver will be rising, as the JPY, the Japan, is a safe haven currency. So if they're selling US dollar JPY, that means they're selling dollar, which in this exchange is viewed as the riskier asset, and they're buying the yen, which is viewed as a safe haven asset. So that moves into something called a risk on and risk off environment, which is something we're going to cover in the later episodes. But if UJ is going up, then they're more risk on, so they want to take risks. So gold will be getting sold, and so will silver. Basically, safe commodities will get sold in a risk on environment, and in a risk off environment, they'll be getting bought. So you can see now gold is rallying due to all the things surrounding the global economy right now, with for lacks of Brexit, for the recent World War III talks, the strikes in between America and Iran. So that's a lot of uncertainty. So you can see investors flock towards a safe investment, which will likely not be affected by the global turmoil, which is obviously gold and silver. Euro yen, so it's euro again versus another safe haven, which is the yen. Euro yen typically follows its own patterns, to be honest. It's more gauged either off euro strength or weakness, or yen strength or weakness. Pound yen again will typically follow euro yen, but just a lot more volatile, because it does have the pound in it and the euro. Like I said, they are affected by their own fundamentals surrounding them, because they are two major currencies as well. So you're likely to see this pair really only moves when one has strength and the other has weakness, or vice versa. Pound Aussie and pound New Zealand, they're just my pound cross pairs. So it's just the pound versus the Aussie. So it's basically a strong currency versus a weak currency. I use pound Aussie as more of a gauge, although I do trade it. So if you see me having a strong run up in pound, then when you look across the board, this is more because pound is kind of viewed as, it's not the safest, but it's not the riskiest. But Aussie and New Zealand are viewed as very risky currencies. So if you see there's a lot of strength in the pound, that means they're buying the pound and they're selling Aussie. And likewise with pound New Zealand, they're buying the pound and they're selling the New Zealand. Euro Aussie and Euro New Zealand, just obviously the counterparts of Pound Aussie and Pound New Zealand, just another cross pair. Typically speaking, Pound Aussie and Euro Aussie more often than not follow the same direction. It's just pound is a little bit more volatile, and Pound New Zealand and Euro New Zealand more often than not will follow the same direction, unless, like I said, there's individual news that affects one currency more than the other. So when there's obviously Brexit news, you can see Pound Aussie was flying and Euro Aussie wasn't really moving like that. Euro Aussie was more moving downwards. That's because of the individual strength and weakness. So that's why my pairs are set up the way they are, because it's kind of a knock-on effect of dollar strength moving into safe haven, moving into the currency, the precious metals, safe investments, and then moving into the cross pairs, which will obviously provide more volume and volatility. So that's just how I utilize all the pairs together. So I just thought I'd make a quick video on it. Moving into the next episode, I'm going to go over the cross pairs and what I look for in them as well. So I hope you enjoyed this episode and stay tuned for the next one.